You know, most traders lose money not because they can't read a chart, but because they can't read themselves. They jump in, they jump out, they chase every flicker on the tape and call it trading. But real trading, the kind that builds capital, not just activity, comes from discipline, patience, and timing. And that's exactly what we're talking about today, how to boost your trading win rate fast. Now, if you watched the previous video on how to trade sideways markets like a pro, you'll remember I said that most of the market's time is spent moving sideways, not up or down. Understanding that is half the battle, because your win rate is built not on how often you trade, but on how well you trade when the market finally decides to move. Let's get something straight right away. There's no trick, no magic indicator, no secret algorithm that's going to turn a losing trader into a winning one overnight. The market's been here before you were born, and it'll be here long after you're gone. The only constant in that equation is you. You have to learn to play the game better than the crowd. Tell me, have you ever wondered why the crowd is almost always wrong at the turning points? That's because the crowd trades emotion. They buy when prices have already run too far, and they sell when the panic is already spent. If you want to boost your win rate fast, you must stop playing the same emotional game. You must learn to stand apart, to see what others cannot, because they're blinded by excitement or fear. I remember when I first started reading the tape, I used to think I could outsmart the market with speed, get in and out quick, grab a point here or there. But what I learned was this: the big money is not made in the buying or the selling, it's made in the waiting. The waiting is where most traders fail, and it's also where your win rate lives or dies. Look at your last 10 trades. How many of them did you take because you were certain the setup was right, and how many did you take because you were bored, anxious, or afraid of missing out? If you can't answer that honestly, you're not trading, you're gambling, and the market has no mercy for gamblers. Here's a truth that took me years to accept. A trader's first job is not to make money, it's to protect capital. Because capital is your ammunition. Lose it carelessly, and you're out of the fight before the real move even begins. Every trade must be justified by logic, not impulse. Do you see how that mindset alone could improve your win rate overnight? Now let's talk about reading the market's tone. Charts don't lie, but traders do. To themselves, mostly. A chart tells you the truth in price and volume. You can see where the buying pressure builds, where it fades, where the crowd is getting trapped. If you can learn to read those patterns, you'll see that the market leaves footprints before every major move. The trick is not to guess, but to wait until the footprints lead you somewhere definite. That brings me back to something from our previous session on how to trade sideways markets like a pro. Remember how I said the real professionals stay patient during consolidation phases? The same patience applies here. When you're aiming to increase your win rate, you must learn to strike only when the odds are clearly in your favor. Every good setup feels boring before it pays off. Why? Because strong trades often form quietly while the crowd is distracted by noise. When I was young, I used to think I needed to be in the market all the time. It made me feel like I was working hard. But the truth is, the best traders spend most of their time waiting for the right shot. Trading is not about constant motion, it's about selective participation. Do you have the nerve to sit on your hands while everyone else is chasing false moves? That's the real test. The fast way to boost your win rate is to slow down your decision making. Let the trade prove itself before you commit. Wait for confirmation. Not hope, not gut feeling, but real market evidence. You'll notice that your win rate climbs not because you found better signals, but because you eliminated bad ones. Another key is learning when not to trade. It sounds simple, but it's the hardest lesson to learn. If the market isn't offering clarity, you're better off preserving your strength. Remember, in trading, doing nothing is often doing something. You're conserving capital, conserving focus, and conserving emotional energy for when the right moment arrives. Every trader faces temptation. The urge to make back a loss quickly, to double down on a bad trade, or to jump early on a hunch. But those are the traps that kill your win rate. The professional trader doesn't react to loss emotionally. He studies it. He asks, "What did I miss?" and then waits for the next high probability setup. That calm, methodical approach is how you build consistency. Think of trading like warfare. You don't charge into battle every time you see movement on the horizon. You study your enemy, you wait for weakness, and then you strike with precision. Your chart is your map. Price and volume are your scouts. Use them wisely, and you'll find that you can anticipate moves instead of chasing them. Let me tell you something that might surprise you. Your win rate isn't just a reflection of your system. It's a reflection of your state of mind. You can have the best method in the world, but if you trade it with fear, doubt, or greed, you'll sabotage yourself. A clear, disciplined mind will outperform any fancy indicator on the market. So when you sit down to trade, ask yourself, am I calm, focused, and ready to wait? Or am I restless and trying to force a trade? Remember, your biggest edge in this business isn't prediction. It's patience. The market will always tip its hand before a big move if you know how to read it. Watch how volume behaves at turning points. Watch how price reacts after fake breakouts. These are the clues that separate the professional from the amateur. And as we tie this back to our previous lesson, think about what happens during those long sideways periods we talked about before. That's where most traders lose patience and burn their capital on small, meaningless trades. But those who learn to stay still, to observe without acting, are the ones who are ready when the breakout finally comes. That same discipline is what boosts your win rate when trends begin, because in the end, trading is a waiting game. The longer you stay in this business, the more you realize that profits are the result of preparation, not prediction. Every successful trader has one thing in common: they know exactly what they're waiting for, and they never settle for less. Your mindset controls your method's effectiveness. That's the truth every trader learns sooner or later, usually the hard way. You can have the best system, the most advanced charting tools, the cleanest entry signals, and still end up losing money if your mental state is out of tune with the market. Trading isn't just a technical game. It's an emotional one, and the way you think determines how well you execute what you know. Let me ask you something. How many times have you had a solid setup on your screen, all your indicators lined up, the chart pattern clear as day, and yet you hesitated? Maybe you guessed yourself, maybe you jumped in too early, or maybe you talked yourself out of it completely. That's not your system failing. That's your mindset interfering. The market doesn't care about your feelings. It rewards those who can control them. You see, trading isn't about being right. It's about being ready. A trader with a strong mental framework will always outperform a trader with a fancy method, but no discipline. Most people think trading success comes from learning new strategies, but that's only half the picture. The other half, the harder half, is learning to manage yourself. The charts tell you what the market is doing, but your mind decides what you're going to do about it. When I say mindset, I'm not talking about empty motivation or positive thinking. I'm talking about a practical, disciplined way of approaching the market. It's the ability to stay calm while everyone else is reacting. It's knowing when to sit on your hands instead of forcing a trade. It's accepting that losses are part of the business, not a personal failure. Tell me, have you ever noticed how your biggest losses usually come right after your biggest wins? That's the mind playing tricks. Success breeds overconfidence, and overconfidence blinds you to risk. Every trader starts out thinking the goal is to find the perfect system. But the truth is, a system is only as good as the trader who runs it. You can give a profitable method to 10 different people, and you'll get 10 different results. Why? Because each one has a different level of patience, discipline, and emotional control. The market exposes character faster than anything else. It shows you who you are, not who you pretend to be. Think about how you react under pressure. When a trade moves against you, do you follow your stop, loss rule, or do you widen it, hoping the market will turn around? When you see a big move you missed, do you chase it out of frustration? Those small decisions define your win rate far more than your technical setup ever will. A strong mindset isn't about suppressing emotions. It's about mastering them. You can't eliminate fear or greed, but you can train yourself to act independently of them. A trader with the right mindset treats every trade as just one of 1,000. He doesn't attach emotion to any single outcome. He knows that his edge plays out over a long series of trades, not in one or two lucky breaks. That's how professionals think. They focus on process, not results. They understand that short-term losses don't matter as long as their method is applied consistently. The amateur focuses on each trade as if it's make or break. That's the difference. Now, if you watched the previous video on how to trade sideways markets like a pro, you might remember the idea that sideways markets test your patience more than your skill. The same applies to mindset. Most traders crumble not because the market is hard, but because waiting feels unbearable. Your brain craves action, it wants constant feedback, it wants to do something. But the great traders learn to use that quiet time to strengthen their mental control. When you can stay disciplined through inactivity, you're conditioning your mind for when the real opportunity comes. Here's something else to think about. The market is a mirror. It reflects your strengths and your weaknesses. If you're impulsive, it'll expose that. If you're fearful, it'll magnify it. And if you're patient and focused, it'll reward that too. The key is to become aware of your tendencies. Keep a trading journal, not just for your trades, but for your emotions. Write down what you were feeling before, during, and after each position. Over time, you'll see patterns, emotional ones, that have nothing to do with the charts and everything to do with your results. A calm trader makes better decisions. That calmness doesn't come from luck, it comes from preparation. When you know exactly what setups you trade, how much you risk, and what your exit plan is, you remove uncertainty, and uncertainty is what fuels emotional decisions. The market may move unpredictably, but your process shouldn't. The tighter your routine, the freer your mind becomes. Let's be honest, everyone wants to make money fast. That's human nature, but the traders who survive long-term are the ones who think in terms of consistency, not speed. They treat trading like a craft, not a lottery. They don't measure success by how much they made this week, but by how well they followed their rules. It's a professional mindset. Would you expect a surgeon to operate differently each day depending on how he felt? Of course not. A trader is no different. The best way to strengthen your mindset is to keep your ego out of the equation. The market doesn't care about your opinions, your predictions, or your need to be right. Every time you argue with price, you lose. Every time you surrender your ego to the market's truth, you learn. The humility to admit when you're wrong, to cut a loss without hesitation, to take a profit without greed. That's the mindset that builds longevity. So next time you sit in front of the screen, don't just check your indicators. Check your attitude. Ask yourself if you're trading what you see or what you want to see. Most of the time, traders lose because they're trying to force the market to fit their expectations. The disciplined trader waits until the market confirms his plan. That difference in mindset is the dividing line between consistent profit and endless frustration. Your method gives you structure, but your mindset gives that structure life. Without the right mental foundation, even the best system will crumble under pressure. With the right mindset, even a simple method can become a powerful weapon in your hands. Because at the end of the day, trading isn't a battle between you and the market. It's a battle between you and yourself. Trade only when the odds are clearly in your favor. That single idea separates the professional from the amateur, the speculator from the gambler. Most people in the market think trading is about constant action. Buying, selling, reacting to every little move. But trading isn't about motion, it's about precision. You make your money not from how often you trade, but from when you trade. The market gives you a handful of moments each week where the odds tilt decisively toward one side. Everything else in between is noise. You see, most traders don't lose because they lack knowledge. They lose because they can't wait. They want to be in the game every minute. The chart moves a little, and they feel they must act. But here's the truth. Every time you trade without clear odds in your favor, you're simply donating to the market. Tell me, would you bet your hard, earn money on a coin toss? Then why would you take a trade without a statistical or structural edge? The professionals understand something that beginners overlook. The market is not a random mess of lines and candles. It's a battleground of probabilities. Your job is not to predict the next tick. It's to find conditions where probability leans heavily to one side. It might be a confluence of technical levels, a volume surge confirming a breakout, or a pattern repeating at a key area. Whatever your setup is, your duty is to wait until the odds align, and not a second earlier. Trading without clear odds is like sailing into a storm with no compass. You might survive once or twice, but eventually, the sea swallows you whole. The market rewards patience and punishes impatience. Have you ever noticed how the best trades often come after long stretches of boredom? That's because genuine opportunities don't happen every day. The tape has to build tension before it releases it. The market must first trap one side before it rewards the other. If you learn to recognize those conditions, your win rate improves naturally, not because you're smarter, but because you're selective. Now, let's talk about what odds in your favor actually means. It doesn't mean certainty. Nothing in the market is certain. It means the probability of success is high enough to justify the risk. If your setup has a 60% historical win rate and a 2-1 reward to risk ratio, that's a favorable trade. But here's the catch: those odds only hold if you follow the rules exactly. The moment you start adjusting stops, chasing entries, or exiting early out of fear, you destroy the math. Most traders lose not because their system is bad, but because they keep breaking its logic in the heat of the moment. Every trade should be like a business decision. You invest in opportunities that meet your criteria, and you pass on everything else. Think of your trading capital as inventory. You don't waste it on weak products. You hold it for when the demand is clear. Ask yourself before every trade, what's my edge here? What am I seeing that the crowd isn't? If you can't answer confidently, you have no business clicking that buy or sell button. In the previous video on how to trade sideways markets like a pro, I talked about how the best traders know when not to trade. That lesson ties directly to this one. Sideways markets are designed to test your patience. They lure you into taking low-quality trades that feel active but carry no real edge. Learning to stand aside when conditions are unclear is one of the fastest ways to boost your win rate. By staying out of the noise, you save capital and emotional energy for the moments that truly matter. When the odds are in your favor, the market feels different. The setup looks clean, the structure makes sense, and the tape confirms your thesis. You can sense the imbalance building. The professionals are positioning quietly, while the amateurs are still unsure. That's the time to strike, not with hesitation, but with conviction. And conviction only comes from preparation. You can't recognize a high odds setup unless you've studied hundreds of them. The truth is, most traders don't really know what their edge looks like. They rely on vague feelings instead of hard evidence. They jump from one method to another, always searching for a magic signal. But the market doesn't reward guessing. It rewards recognition. You have to build a catalog in your mind of setups that statistically favor your side. Once you've done that, your job becomes simple: wait until the market shows you that pattern again. Trading only when the odds are in your favor also means embracing inactivity. That's hard for most people. It feels like wasted time. But in reality, waiting is working. Every moment you don't trade is a decision to protect your capital until opportunity arrives. That restraint is what separates the seasoned operator from the restless speculator. Do you think the top traders in the world are glued to every tick all day long? No. They watch, they wait, and they act when the picture is clear. The danger of low odds trades isn't just the loss of money. It's the erosion of discipline. Every impulsive trade weakens your ability to follow your plan. And once discipline cracks, everything else follows. That's why I always say, your best trades are the ones you don't take. Passing on a weak setup is a win in itself. The moment you start protecting your capital, as fiercely as you chase profit, your entire performance transforms. Think of your trading account like a fortress. Every trade you take opens a gate. You only open it when the enemy is exposed, when the odds clearly favor your attack. Otherwise, you keep those gates locked. The amateurs leave every gate open, hoping for luck. The professionals guard every position with strategy and timing. The market will always tempt you. There's always a candle forming, a move starting, a voice in your head saying, "What if this is the one?" But that's emotion, not logic. The disciplined trader learns to silence that voice. He understands that not trading is part of trading. That mindset is what keeps your win rate high, your emotions stable, and your capital intact. When you look at a chart, don't ask, "Can I make money here?" Ask instead, "Do the odds favor me here?" That one shift in thinking changes everything. Because in trading, you're not rewarded for participation, you're rewarded for precision. The market doesn't care how many trades you take. It only pays you when you're right at the right time. And those right times, they're rare, they're subtle, and they require patience to see. The trick is to train your eye to spot them and your mind to wait for them. Because the longer you trade, the more you realize that the best trades almost call out to you. They feel obvious, clean, and aligned. And when that moment comes, when all the conditions line up and the odds tilt your way, that's when you act swiftly, without hesitation, without doubt, and without apology. Avoid emotional trading. Wait for market confirmation. That single rule sounds simple, but it's one of the hardest to follow. Every trader starts out believing they'll trade logically, that they'll make decisions based on signals, not feelings. But the market has a way of stirring emotions like nothing else. One moment you're calm, the next your pulse is racing, and you're reacting instead of thinking. The truth is, emotional trading is the silent killer of trading accounts. It doesn't just take your money, it takes your discipline. The market plays on human nature. Greed makes you jump in too early, fear makes you exit too soon, and ego keeps you from admitting when you're wrong. You think you're following your plan, but in reality, your emotions are running the show. Tell me, have you ever moved a stop, lost because you just knew? The market would turn around, or entered a trade without confirmation because you were afraid of missing out. That's emotion disguising itself as conviction. It feels right in the moment, but it's poison to your results. Market confirmation is the antidote. It's the process of waiting for the market to prove your idea before you risk your money. You may think you see a reversal forming or a breakout about to happen, but the professional waits for price to confirm it. He doesn't guess, he observes. Because in this game, being early is often the same as being wrong. A confirmed move tells you the market agrees with your thesis, and trading in agreement with the market is the only safe way to trade. Emotional trading usually happens when traders crave control. The market feels uncertain, so they act impulsively to regain a sense of power. They think doing something, anything, will relieve that tension. But every impulsive action in trading comes with a cost. You can't force certainty out of an uncertain environment. The only way to stay ahead is to let the market reveal its hand first. When you wait for confirmation, you're not being passive. You're being strategic. You're aligning your decisions with the rhythm of the market, not your emotional impulses. Think back to the previous video on how to trade sideways markets like a pro. Remember how I said that sideways markets are emotional traps? That's where confirmation becomes even more critical. In those choppy conditions, false signals and fake breakouts are everywhere. The traders who jump too soon get chopped to pieces, while those who wait for confirmation, real volume expansion, clear trend direction, are the ones who survive. The same principle applies to every market condition. Let the market validate your analysis before you commit. One of the biggest misconceptions about confirmation is that it means you'll miss the best part of the move. That's not true. You might give up the first few ticks, yes, but what you gain in confidence more than makes up for it. The trader who waits for proof trades with conviction. The one who guesses trades with doubt. Conviction keeps you in a winning position longer. Doubt makes you exit too soon. Waiting for confirmation doesn't cost you profit. It buys you clarity. Here's what emotional trading looks like in real time. You see a breakout candle, big and green, and your instincts scream, "Get in now." You click buy before thinking, convinced you're catching the start of a move. But without confirmation, without a retest, without volume support, that candle can turn into a trap. Suddenly it reverses, stops you out, and you're left frustrated, wondering why the market faked you out. But it didn't fake you out. You faked yourself out by trading emotion instead of evidence. Waiting for confirmation means you let the market make the first move. It's a partnership, not a fight. You don't predict. You react with precision. Confirmation might come in many forms: a high or low forming after a breakout, strong volume confirming a direction, or price holding a key level after testing it. Whatever your method, the idea is to let the market prove it's ready before you engage. The amateurs trade what they feel, the professionals trade what they see. When you learn to avoid emotional trading, your win rate improves not because your strategy changes, but because your execution does. You stop taking low-quality setups. You stop chasing price. You wait until everything aligns, and then you strike. That shift from emotional to evidence-based trading is what transforms chaos into consistency. It's not about removing emotion completely. You can't. It's about managing it, recognizing when it's influencing your judgment, and refusing to act on it. I've always said that a trader's biggest edge isn't his system. It's his self-control. The market will test you daily. It will tempt you with near-perfect setups that lack confirmation. It will whisper in your ear, "Just this once. Take the trade. You'll be fine." But every "just this once" erodes your discipline a little more. The traders who last are the ones who can silence that voice and wait for their signal. When you're waiting for confirmation, you're also training your mind. You're learning patience, restraint, and the power of deliberate action. Every moment you choose not to trade emotionally is a victory for your discipline. You're building a mindset that values precision over excitement. The excitement of impulsive trading fades fast. The satisfaction of disciplined trading compounds over time. Sometimes, the market will confirm your setup and then reverse anyway. That's part of the game. But even then, you made a high-quality decision. The outcome doesn't define the quality of your trade. The process does. By following your rules, by waiting for confirmation, you put probability on your side. Over hundreds of trades, that discipline shows up in your equity curve. Let's be honest, emotional trading feels powerful. It gives you the illusion of control. But the moment you let emotion dictate your trades, you hand that control back to the market. Waiting for confirmation, on the other hand, feels boring. It requires patience. But that boredom is where consistency lives. The professional trader embraces it. He knows that every trade taken out of boredom or excitement is a step backward. You'll notice something interesting once you master this discipline. The fewer impulsive trades you take, the clearer the market starts to look. You stop seeing noise everywhere. You begin to notice the rhythm of price action, the natural flow between accumulation and distribution. You start trusting your setups more, not because the market changed, but because you did. Emotional noise fades when confirmation becomes your standard. And when that happens, trading becomes quieter, steadier, more controlled. You no longer feel the urge to chase. You no longer panic at reversals. You act only when the market gives you permission. That's what waiting for confirmation really means. It's a contract between you and the market, where you agree to act only when the odds and evidence stand clearly on your side. Preparation and timing beat prediction every time. That's a principle every serious trader eventually comes to understand, though most learn it only after losing enough money trying to outguess the market. The beginners think trading is about forecasting, about calling tops, bottoms, and future moves before they happen. But the truth is nobody can predict the market consistently. Not me, not you, not anyone. The professionals don't try to know the future, they prepare for it. They wait for the market to reveal where it wants to go and then act with perfect timing. You can't control what the market does, but you can control your readiness for what it might do. That's where the edge is, not in prediction, but in preparation. The prepared trader knows what setups he's looking for, what levels matter, and what conditions must align before he takes a trade. He has his plan written down long before the market opens. The unprepared trader, on the other hand, comes in looking for excitement, waiting for the market to tell him what to do. By the time he reacts, it's already too late. Have you ever noticed how some traders seem to enter and exit at just the right moments? It's not luck. It's preparation meeting opportunity. They've already studied the charts, identified key zones, and visualized possible scenarios. So when the market moves, they're ready. The timing looks effortless because the work was done beforehand. The trader who tries to predict is always one step behind. The trader who prepares is already in position when the move starts. Prediction is based on hope. Preparation is based on process. When you predict, you're emotionally attached to being right. You look for signs that confirm your opinion and ignore evidence that contradicts it. That's how traders dig themselves into holes, by defending a forecast instead of responding to reality. But when you're prepared, you have no emotional attachment.